Hello, and welcome to our newest podcast series, Credit Without Constraints, sponsored by our friends at Spinwheel. You all know by now that I'm an unapologetically huge nerd when it comes to credit, particularly the infrastructure that sits behind the scenes and enables credit. The mechanics of that infrastructure, the credit bureaus, credit scores like FICO, regulations like the Fair Credit Reporting Act, fascinate me. However, the reason that I spend so much time researching, writing, and talking about that infrastructure isn't that it's interesting to me, it's that it's important. Trillions of dollars a year run through that infrastructure. The economy at large depends on that infrastructure. And critically, that infrastructure is changing. In fact, I would say it's changing more and faster now than it has in the past 6 decades combined. Open banking and the rise of consumer permission cash flow data, the rapid and iterative development of new lending product structures, AI. The credit ecosystem is in flux. Every part of the consumer credit lifecycle is being refactored. And that's what this podcast series is about. Exploring how credit infrastructure is changing, how structural constraints, which a lot of us take for granted because they've been around forever, are being removed, and the opportunities and challenges that those changes are bringing. In this episode 1 in our series, I talk with Tomás Campos, CEO of Spinwheel. Now, Tomás lives and breathes this changing consumer credit ecosystem every day. And as you will hear, he has a very thoughtful approach for how to navigate it. In our conversation, we talked about the origins of Spinwheel, his yes and approach to building credit data infrastructure, the enduring importance of the Fair Credit Reporting Act, and of course, because it's 2026 and we have to do it, AI. Tomás was wonderful to talk with, and I'm very excited that he will be joining me as a co-host for the remaining episodes in our series, which will also feature some incredible guests from the credit data ecosystem. So without further ado, here is episode 1 in our new series, Credit Without Constraints. Okay, well, Tomás, thank you so much for coming on.
Yeah, I'm so excited to be here.
I am very excited to have you. I'm excited to be doing this series with you guys, actually, because as you know, we've had a chance to talk over beers a couple of times and then really sort of exchange notes on this stuff. I am a dyed-in-the-wool credit data lending nerd. This is like what I spend most of my time thinking about. Any time spent on other topics is me getting dragged away from this topic. So very thrilled to get the chance to go deep on it with you in this episode and in this series. Let's start just for setting a little bit of context. For folks who don't know you or know Spinwheel, could you give us kind of a quick introduction to both?
Happy to. So you had a founding group of folks who had been building fintech infrastructure for the better part of 20 years together. And when we set out to go do our second startup together, we were really obsessed with consumer credit. We just kept on looking at the market and we saw 2 big things that were staring at us. The first is that if you looked at the household balance sheet, credit and liabilities was the biggest part of the balance sheet. You have more liabilities than you have investments and assets combined as far as the average American household goes. And then we looked at the infrastructure that was out there and we couldn't see anything. And this is at a time when you saw, really great fintech infrastructure like Stripe or Plaid or other solutions out there. And we just said, hey, why is it that nobody's tackling that side of the balance sheet? So that was the idea. But what really sparked it for us was when I had family members that really started struggling with their own journey with debt. So, sister who basically had to delay buying a house because of her student loan debt, niece that was thrilled to have graduated but distraught over the fact that she had racked up a bunch of student loans. Mm-hmm. And I remember very distinctly when that happened, my co-founder said, hey, well, why aren't we doing this? Like, we've been thinking about it. We've had a thesis. We've built infrastructure. Let's go do it. And so that was the spark behind the company. Our path was probably a little bit unconventional in the sense that we really started focusing very heavily on the consumer side, almost to the point where we had visions about building a consumer app. We really want to understand what features consumers needed, the entire life cycle that they went through, and we interviewed hundreds of people, and that genesis really still um, informs and guides the company today, because everything we do is really focused around how do we improve the financial outcomes of the consumer as well as our partners. So we very quickly realized we're much better at building infrastructure than we are building apps. And we also realized that most of the apps that we'd seen out there in the market were either failing or had failed because there was no infrastructure to truly power what they needed on that side. And so it reinforced our understanding of what's needed in the market, but also gave us a really great North Star on how we can go tackle it, how we address these consumer needs, but also make something really, really valuable to the companies that we were going to approach.
Fascinating. That is really interesting. And I think, both the gap you guys saw in the market was obviously a real one. And we're going to talk in detail about that gap. But also, I think it's interesting that, that journey, what you describe is actually, it's very common that I've noticed in the fintech infrastructure space where it's like, hey, we see a gap in terms of like the end products that need to exist. Oh, okay, I'm sure this will be like relatively straightforward to solve. Oh, wow, there's actually a huge infrastructure problem hiding behind this. And a lot of times what I find is that like when you ask why hasn't someone built this, a lot of times it's because the right tooling isn't there for someone to build it. It's not that other people haven't necessarily seen the same problem that you've seen. It's that the infrastructure is very difficult and it doesn't work well. It's not set up to solve a specific problem. And I want to maybe hone in on that for a second before we start talking broadly about the credit system that we have in the US. One thing that strikes me as interesting, and it ties back to your point about sort of this being the largest part of the average consumer's balance sheet, are these like is debt, liabilities. What's interesting to me about that is that I spend a lot of time talking to banks or to lenders, and what's funny to listen when they talk about this stuff is they'll be like, oh yeah, they'll talk about their loan book and it's an asset to a bank, right? It's an asset to a lender. So they talk about it as an asset, and they talk about it as like, this is how we're going to grow. This is how we're going to make money. This is fantastic. And when you talk to a bank about its liabilities, meaning its deposits, the money that it owes to people, it talks in this like very careful language about like we have to worry about interest rate risk, we have to worry about duration, we have to make sure everything is secure. Like we have to be so careful with this liability that we have. And yet, strangely, what I find is they very rarely tend to think that the thing that's an asset to them is a liability to their customers.
That's right.
And they don't tend to think about it that way. And I remember doing a consumer survey a long time ago now, but we sort of intentionally asked consumers about sort of their finances without asking in product terms, right? We just wanted to get sort of a general sense of like, how do consumers think about their finances? What are the biggest challenges they have relating to money? And one of the findings that stuck out to me that's always just stuck in my head is a lot of consumers said, I don't know how to use debt productively as a tool. And I thought that was such a fascinating kind of first principles type finding out of that survey, because it speaks to the same challenge of, if you're a bank, like, how to treat liabilities in a careful, strategic way that is additive in value to your organization, but avoids like all of the challenges that you can fall into when managing a liability. The tooling and the experiences and the products that we've built to help consumers manage their own liabilities is really lacking. And in that survey, they were sort of expressing that thing where they're like, look, I know debt isn't necessarily evil. I know it can be a really important tool, but I feel like I'm using that tool badly. So maybe you could comment on just like that sort of framing and what your experience, especially early on when you guys were thinking about what consumer products need to exist in this space, like how that matches up against that.
I think that you nailed it. It was exactly that. When we were talking to consumers, it was that message, oftentimes with people having tears in their eyes because they either felt that they had mismanaged it or they had too heavy of a load on their back. But it's exactly that. It's a combination of, when does it make sense to take on a liability? What are the right terms? What are the right ways to leverage that liability so that it improves their lives? And then how do you get smarter about it as your financial picture changes? As interest rates change or as your income changes, your asset changes, how do you just make sure you're being smart about that? We kept on hearing that over and over and over again. And as the quote unquote fintech person in my family, people would come to me and be like, well, what's the right way to do this? And I realized, like, one, I know how to build infrastructure. I know how to build the tooling and the platforms. I couldn't answer their question well. And
Right.
the other thing I realized is that the answer to those questions were actually very highly personal, very highly tailored to that individual. You might have some of the more generic rules out there, which is, how to manage interest rate or, the snowball or avalanche method. Those are great, but fundamentally every individual has their own needs and their own sets of goals that they're trying to achieve in their scenario. And interesting enough, when we spent a lot of time on this, we actually boiled it down to 4. So the 4 that we realize is that these goals typically, they're not mutually exclusive, but typically one's weighted higher than the other. But it's typically going to be something around, hey, I want to optimize the cost of my debt, right? The second one might be, I want to get out of debt faster, right? The third might be, I want to optimize the amount of money, cash outflow I'm paying every month towards my debt, right? And the third might be, okay, I want to actually get into new debt. To achieve some goals, to achieve some outcome that I'm looking for. Now, again, those aren't mutually exclusive, but when we looked at those are the sort of 4 consistent things we saw over and over again. And we realized you actually have to have all the information to actually power the answer to those. So you're absolutely right. And I would also say that most of the time what we found is that through the consumer journey, and we saw this truly as a journey from educating yourself on maybe what the right steps you should take towards one of those goals, to receiving a product like a loan or credit card, to using it and then repaying it. There's nothing that really helped the consumer across all that and stitch it all together. And most consumers see that as a very disparate experience in their lives. And that's one of the things that we said, hey, can we change that? Can we make this something that's more comprehensive, more holistic to help consumers achieve those goals while improving the financial outcomes and the positions of the companies that serve these customers?
That makes a lot of sense. And it ties back to a thing I wanted to ask you about next, which is the data point, right? And I think that's exactly the right diagnosis of the problem, because from the consumer's perspective, debt is not like a siloed thing. Liabilities are not siloed, right? Like they all stack on top of each other. Credit risk professionals think of this as like second order effects, right? Like it's not just how much debt you have. It's, hey, if I add this debt on to the debt you already have, how does what you already have impact your repayment of this debt, right? So debt is a cumulative consideration. And it's the way that lenders, by the way, think about this, right? When they're lending a consumer money, they don't think just in terms of what they're doing. They think about the entirety of a consumer's liabilities. However, I think what you are pointing out, and that's really interesting and what I want to get into next, is that same visibility is really difficult for a consumer to get, right? It's very like your lenders always want to talk to you about the money you owe to them specifically, but no one is really able to kind of give you a full picture of like, here's all the different liabilities that you have. Here are the various amounts of money that you are paying to pay down those liabilities. Here's maybe a different way to think about how to optimize the cost of that, to optimize the sequencing of which ones you pay back, to understand how a different new piece of debt for a goal that you have might fit into what you already have. Like none of that is surfaced to a consumer. None of that is made available. And so I'm curious to kind of drill a little deeper. I am probably more curious than anyone on earth about the structure of the sort of credit data ecosystem. And I know you are similarly very passionate about this. Where do you think right now the gaps are in the sort of traditional credit data system?
Yeah. So first, maybe an outlook on how I see the traditional credit data system, and then we could talk about what were the gaps. First, I don't think you can have this conversation without talking about bureaus and bureau data. And I have to say, they are the OG aggregators. It is probably one of the most fantastic business models that have ever been created.
Totally.
And I think they provide a ton of value in the ecosystem. The challenge with that is that sometimes there are gaps because this is data that is based on a sort of furnishing model where issuers and creditors have to push the data at some frequency. Now, there's nothing that says you have to do it once a month. Nothing says you have to do it once a day. So most most issuers and creditors will furnish it based on a due date cycle.
Sure.
And that's great. And there's a ton of value in that. The challenge is when you look at that, you're missing all the data points in between. You're missing all the real-time data. You have no ability to sort of understand some of the details between a trade line and the underlying asset or property or loan itself. And then if you want to think about how you can take any action on one of those things, such as like a repayment or refinance, well, that's left up to someone else. There's no one else that you don't get that from the traditional bureau data. So then from there, what we've seen is companies look at all these other solutions to sort of plug those holes. So they'll go look at things like public records data, and they'll use solutions like LexisNexis, right? And say, well, I got to go get some data from here, and then they'll go try and plug into different providers for understanding maybe a property or asset information, or they'll look at information such as banking and cash flow data. And so the common story we've heard over and over and over again is that any one of these lenders, any one of these banks, they on average tell us they have about 14 disparate and distinct integrations on their back end that they have to try and close those gaps. The challenge is that, one, they're still not able to close those gaps because the data is either approximated or inferred. There's no sort of ground truth oftentimes. And the second thing is it creates a ton of friction and overhead, both for the lender, the bank, and the end consumer, right? So when you think about a consumer experience and they have to put 40 pieces of data in, and they have to put in, 5 username and passwords, and they have to do an OTP, like that's a ton of friction, but that's a direct result of people trying to close these gaps. And on the back end, you have these 14 integrations with, a cost that each of them have, and you're trying to tie the data together. And so what we see is that these gaps are real, and it boils down to understanding the real-time data. So you don't have that real-time data, to the accuracy of that data, and then being able to do it in a way that does not create that overhead of friction for both the consumer or the company.
So you just touched on a ton of stuff that I want to ask you about. And I will start by saying that, to emphasize your point, and this is the point I make all the time, by the way, the credit bureaus are great, right? Yeah. Like they are a marvel of the modern economy, I think. And it sometimes takes like operating in different countries or sort of looking at different systems to appreciate like the depth and breadth of the data that's available. I will also say a thing that is sort of underappreciated that we're still working on, I think, in other aspects of this problem is, things like coverage, connectivity, yes. Like, the traditional bureau system creates a ton of value just in terms of like, hey, if I give you last name, last four of social, address, like boom, I'm going to get a response, and it's going to be fast, and like it's going to be pretty accurate. There's a lot that the bureaus, I think, have built that's like a good infrastructure. But I think the flip side to that, you can, and it sounds like a contradiction, but it's not. Like you can say the credit bureaus are great, and you can also say the credit bureaus are far from perfect, and both of those things are true.
That's
at
right.
the same time.
No, that 100%. And I think by the very nature of how they exist, it is difficult for them to be perfect. But right. It shouldn't stop the goal to make to close those gaps so that you can improve the financial outcomes of both the companies and the customers who depend on that data.
Yeah, I totally agree. And so speaking about some of those gaps, and you mentioned some of these, but I just want to pick up a couple of these threads. One that you mentioned is just the real-time nature of data. And I think that one is fascinating to me because it sort of speaks to, and I think it's important when we talk about infrastructure this way, like the credit bureaus as we understand them today were built in like the 1970s and 1980s, right? And so just our understanding of data and how data would be used and how you would model on top of data and systems that would take data in, it's just very, very different today than it was back then. And so again, to your point, like I don't really fault the bureaus for that. I mean, they had to build a system with what they had at the time. But as you say, a lot of the data is not real time. It has this sort of lagging nature to it, right. Which as we see in kind of credit and lending, can be very dangerous, right? If there's something you don't know based on a delay in time, like as a lender, that's what you always worry about and are paranoid about. And I think the other thing, I'd love to get your comments on this, is I also think like lending as a category continues to innovate, right? And we see lots of new like product structures and new types of offerings that just don't fit into the sort of traditional credit bureau boxes that were sort of designed in the 1970s, 1980s. Buy now, pay later is probably the best example of this, but there's lots of other ones too. Like lending innovation doesn't stop, but a lot of times, both because of the speed of the data and the structure of the product itself, it just doesn't fit nicely into traditional credit bureau kind of data structures. Can you talk a little bit about like that challenge and particularly from like a lender's perspective, like where that creates friction?
Yeah. I mean, I think you can just take two examples that really make the point. The first is if you think about any revolving line, especially credit cards, right? The very nature of the credit card, the balance on those credit cards can change at any minute. And so for any creditor, anybody trying to engage with a consumer on that liability, if you don't know what's on that credit card today, you are getting an inference, you're getting some signal of what it is potentially. And as you just said, that's not necessarily what creditors, that's oftentimes not what consumers need to know to make the right decision, whether it's an underwriting decision or decision to take a product. So being able to get those real-time balances on credit cards is extremely important. Our clients use it to understand exactly what the DTI of a customer is. They also use it to understand, potentially if there's a loan stacking risk that maybe hasn't materialized yet. On the flip side, consumers use that to understand, like, hey, what are the cards that I have the most money on that I should pay down? What are the ones that I use the most? Is it the ones that I should be using the most? So that's an extremely important piece of data that doesn't exist in the existing bureau infrastructure today. The other thing is any loan, it is a function of time. And so as you know, with interest typically is accruing on a daily basis. And so when you think about even installment loans, think of a home loan or a personal loan or an auto loan. Today, the process of getting what a payoff quote is a pretty difficult process, right? You have to actually either go and call the other institution and ask for a payoff demand letter, and that either is done by the consumer or it's done by the new lender. But they have to go get that. That takes a lot of time and money, right? But if you can in real time get what that payoff quote is and a good through date that says, as long as X dollars is paid by Y date, that's extremely important for any lender that, one, is trying to understand the true liability that the consumer owns up to this date, and anybody who's working with that consumer to do a refi, a payoff, a consolidation, which drives so much of the credit economy today. Mm-hmm. So those two examples are, when you think about the real-time nature of the data, super important to the ecosystem that we're talking about.
I'm glad you gave those two examples because they touch on two other things that I think are important, right? One is on the example of like the payoff amount and payoff date. There is a business model element to some of this as well that I think is fascinating, right? And you see this actually across the board. It goes back to BNPL too in terms of furnishing data. Like there's a business model component to, on an individual level, even though this is good for the ecosystem overall, BNPL lender or lender who has a customer with an installment loan, I might not actually love it if they refinance my particular loan. Or in the case of a BNPL provider, like you can understand it's 2026. Like I'm not in the business of giving data away so that my competitors can use it, right? So even though this is always the tension in the credit data ecosystem, I think, is that like what's good for the goose is not good for the gander and vice versa. And I think that, systems that are in place have a hard time, like the credit bureaus, managing some of those conflicts, especially when things change, right? And so again, when people ask like, well, why do we need more infrastructure here? What we just have the credit bureaus, like things change, and navigating these tensions makes that very difficult. The other thing you mentioned that I just want to emphasize, because I think it's really important, is the credit card balance example. I think that's fascinating because what you just described about credit cards being challenging from a lending risk underwriting, understanding the risk of a customer at any one moment perspective, That's also, if you flip it around, because again, we have to sort of flip between the lender's perspective on these things and the consumer's perspective. The consumer's perspective is, I love having an open line of credit that I can use as needed on a day-to-day, minute-by-minute basis. So the convenience we are offering to consumers becomes a challenge for lenders who are trying to
100%.
evaluate their risk on a minute-by-minute basis. And I think what I hear you saying is these trade-offs or these challenges in a lot of cases can be made better or solved to a degree by infrastructure that's kind of built for it.
That's exactly right. And that's really the thesis and why we exist. You nailed it. It is those gaps, those blind spots, they lead to imperfect decisions. They lead to consumers getting into the wrong products. They lead to a lot of cost in the ecosystem. And if you can do this well, and that's our goal, you eliminate that cost, you provide more of that transparency, and all boats rise. Consumers get a better outcome, lenders get a better outcome. And I want to talk a little bit, you brought up a really interesting point about, well, hey, is there a tension here between, let's say maybe more people paying off something than they would have before because they have more visibility?
Sure.
What we found is actually that's not the case. What we found in our experience has been twofold. One is by the time the consumer has already gotten to the point where a payoff demand letter is asked for or any one of those things, you're not accelerating that. You're not changing the equation where you're seeing more of those happen. What you're doing is you're just eliminating the cost and the overhead that existed from that same action. So said otherwise, you're not increasing that action. You're just making it more cost efficient and you're making it more accurate. That was the first thing we saw. The other thing that we saw was that when you reduce the cost and you make it more accurate, the outcome is better for even the lender that is actually getting paid off.
Sure.
Because think about it this way: a lot of times, if that data is not out there, you're either getting a payoff for the wrong amount, too much or too little. Now you have a customer service issue where you have to engage with that consumer and say, well, hey, you have a credit now where you had a debit, or you didn't pay enough, and guess what? Now interest ran on that $20 that you had, and now you have to pay that. So if you look at it, it actually helps both parties because it's just a moving thought. Now, again, we had some of our earlier customers who were worried about, like, well, we're going to have so many more customers want to pay off all these loans, and that's how we make our money. And after running this for years, they didn't see it. They actually saw that it was the same amount, the same rate, but just lower cost, more accuracy, lower customer service issues. And those same customers who paid off, they were happier with that lender because they didn't have a bad experience on the way out, or they didn't have a bad experience when they tried to pay up. So it's counterintuitive, but it's a common perception that we run into when we're out there.
Yeah, I'm glad you mentioned it because I try to say this all the time, and it bears. I always want to get on a roof and like shout it as loud as I can, but it's like
likewise. I'll be with you on it.
Okay, I appreciate it. You can come up on the roof with me. I mean, it's annoying because I think traditionally in financial services, inertia has been a moat, right? So it's like, hey, if we just don't make it easy for the customer to do this, they won't, and then we'll be happy, and they won't be happy, but they'll live with it, and it's fine, and whatever. And I think you made the exact right point, especially today with the amount of like competition and options available, and just the empowered nature of consumers these days, right? Like I sometimes describe it as consumers have woken up. Financial services consumers in the US have woken up, and there is no getting them to go back to sleep. There is no stopping them from doing what they're going to do. The only choice you have really is, do you want to be the company that enables your customers to do what they want, even when it might in a narrow, limited time series way be bad for you economically? Or do you want to be the company that makes it difficult for them to do it, still suffers the costs of them doing it in the short term, but also damages your brand, your relationship with that customer, creates operational issues for yourself, for your call center, your customer service team? Like, it's not a choice between having customers who are asleep and having customers who are awake. Your customers are awake. They're going to do what they're going to do. And your choice is, how good are you going to make your part of the ecosystem for them to interact with? So I think, just to emphasize the point you made, that is so important as a way to think about this, because it actually segues to the next thing I wanted to ask you about: consumer permission. Yeah. This, I would say, is the other big thing that's changed in the sort of landscape or ecosystem over time, right? Is in a narrow sense, you could say that the credit bureaus operate on a consumer permission structure, kind of.
Yes. Yeah.
And I think that's true, right? Like, the data gets furnished about you. You are granting access to your credit file when you apply for a loan. You check that box. You have some rights, and we'll get to FCRA, I promise. You have some rights to be able to dispute data, to look at your data, make sure it's accurate, all that kind of stuff. But I would also say, and again, thematically here, this is tying back to the idea that the credit bureaus were started in the 70s and 80s in the incarnation that we know of them today. The idea that, like, you would have a device that you carry around at all times that you could use to granularly grant permission to different data about you and to revoke that permission and to see exactly how it's being used on a minute by minute basis. I mean, that's science fiction in the 1970s and 80s. Today, it's the life that we live. And so it's not surprising to me that, and you would have a better sense of this history than I would, but like at some point in the last 2 decades, we sort of grafted onto this idea that, like, A, consumers own their data, which I think no one disagrees with that statement. B, we now have the technology for consumers to permission access to their data in a more granular fashion than they used to have before. And C, because of that technology and the way we've improved things, the scope of the data that consumers can permission and the access to it changes, right? And I used to work at FICO, so I happen to know this story personally. If you talk to executives who were at FICO in the very early days, they would have said, hey, like, we would have loved to have had cash flow data and to incorporate it into the FICO score. We just couldn't get access to it. There was no easy pipe that was available at the time. So talk a little bit about how consumer permissioning, cash flow data, other sources of data combined with consumer permissioning are sort of addressing some of these gaps we've been talking about.
Yeah. So I look at it, I think there's 3 big pillars, maybe 4. So the 4 big pillars that I look at this are, one is the consumer having control over this. And I put that as they have to have control over the permissioning, right? So that's the very first thing. The second thing is they have to have the ability to give the permission and revoke it when they need. So that's under the control, but make it conspicuous enough so that the consumer knows that they are granted permission. At the same time, don't make it so onerous for them that they give up halfway through.
Yep.
Right. So there's a balance that you have to do. The leads to the third one, which is the friction. You have to do it and we'll talk about this more, but when you look at the scope of the data and where this data resides, it's not one place. You have to be able to enable this solution to do where the consumer gets all their data from, and doing that in a frictionless way is really, really important. It's difficult, but really, really important. And then the fourth one, which I think underscores all of this, is in a secure manner, right? You never want to be able to have a situation where, consumers' data gets out where they didn't expect it to, or someone else is able to access the data on behalf of them because they were pretending to be that person. So those are the 4 pillars. With those 4 pillars, you then now have the underlying framework to build the infrastructure that essentially adheres to those pillars. And then it's now how do we go plug in to all these data sources to fill those gaps? So when we talk about things like supplemental or additional credit card data, well, that resides so many different places. Right? It's not just, there's bureaus, there's the issuers themselves, there's bill pay networks, there's payment networks. There's all this information out there that you have to orchestrate and pull together in a way that basically adheres to those 4 pillars I talked about. And if you do that, now you're really providing value and you're doing a secure way to this customer. So real-time information on credit cards needs to be able to do that. Payoff information, even things like being able to get disambiguate what is on a home loan trade line, right? This is something anybody who owns a home, on your trade line typically does not represent what you pay just for the loan. It typically represents what the payment is to the servicer.
Mm,
And that payment as a service typically can have other pieces in there. It can have insurance like PMI. It can have taxes that are either
yeah.
impounded or escrowed.
Yeah.
But like, it's really hard to do. But if you
Totally.
actually, based on those four pillars I talked about, the control, the ability to permission, frictionless, and security, you do that in the right way. Now you have the ability for the consumer to say, I want to go get my information from where this exists, pull it in, use it in addition to the bureau data, and share it with the person or the company that I want to. And then at any point in time, if I want to revoke that, I want to be able to revoke that. I want to say, I don't want that shared anymore, or I want it shared for a period of time. And for us, that's really important. So when we think about just the most fundamental aspects of what we do at Spinwheel, it is those things. It's those four pillars, the technology that enables those, and then now how do you expose it to both the consumer and the company?
So, getting into that a little bit, because that's a great way of describing it. I sort of think of it as like permission just completely changes the surface area where you can attack this problem, right? Because there are certain types of data that the data is accessible in different models, right? Some of it is available via consumer permissioning. Some of it is available through the credit bureaus. Some of it is available directly system to system, right? And so, like, all of these different places that you can go get data, and the home loans is a great example, right? Like, how much better could you do of assessing this trade line if you had the granularity of data that you could get? Okay, well, where do we get that data? And what do we need in order to unlock access to that data? And so it becomes enormously valuable. And you and I have talked before about this idea that, like, when you're trying to assemble a full picture of kind of someone's liability side of their balance sheet, you have to take sort of a yes and approach, right?
100%.
The classic line in improv is like yes and you're like always adding to the skit. You take a similar approach with credit data infrastructure where it's like yes and we also want to go get this, and yes and we also want to go get this. And I think in terms of getting the most granular, useful, accurate, predictive data in as comprehensive a manner as possible, that's what you have to do. However, the other thing that you mentioned that I want to drill in on is things like permissioning, right? Where it's like, okay, what you just described is great. It would benefit consumers, it would benefit lenders, but boy, that's a lot of work. And if I have to, as a consumer, permission every single one of those individual steps and log into 19 different systems and do all of these different things, like, that is quickly going to break that experience. And I imagine this also exists like on the back end with lenders too, right? Like, I need to have a way to weave all of those things together into a workflow where I am sequencing for reliability, coverage, cost, uptime, all of these different things. So maybe both on the consumer experience side and then on the kind of the lender backend side, can you talk a little bit about how the yes and approach to building data coverage, which as we talked about is like critical for solving this problem, like how you solve for the good problem that creates of like a lot of potential friction and a lot of potential challenges for lenders?
Yeah, I think it actually fundamentally started with a paradigm shift, and a architectural shift from things that approximated who someone is. So things like credentials, a password, using a password, things like that,
Sure.
were indicators that this is Tomás, or these are indicators that it's Alex because he has a password that only Alex should know.
In theory.
Shifting that model to understanding the true identity and verifying the identity of the individual. And so that's actually one of the key things that we do very distinctly is our entire system, entire platform is built around the user, is understanding who the user is and being able to authenticate who that person is. And I would say that's actually, when you go back to like the 70s, identity verification was a much different business, back in the 70s.
Oh, yeah.
Now we have fantastic technology that can truly authenticate and identify and do a full identification of the individual. And so if you take that approach, you actually start moving away from two things. One, the consumer having to go and identify all their accounts themselves because we actually know who this person is. And two, you don't have to get into a model where you have that overhead of someone trying to remember 14 username and passwords, or them trying to go and connect to every single account themselves. So what we've done is we said, well, as long as we have the confidence and can prove that this is actually the individual who is who they say they are, can we then use that as the authentication scheme to go then work with their accounts? And it's, when you think about it this way, when you create a bank account, no one asks you to start by putting in the username and password. Like, that's the last thing you do. The first thing you're doing is like, are you actually Alex Johnson?
Yeah.
Are you on any list that you shouldn't be on, that we can't even give you a bank account, right? They do all things first. And then after that, they go, okay, well, let's give you a username and password. And that's a function of how you can get back into your account in the future. It's not actually a function of identifying you. So for us, we took that same approach and said, well, listen, if every institution has already had to do something around identity and they already had a way to prove who this person was, let's plug into that. And that allows us to say, hey, can we easily discover the account for the consumer? And two, can we easily integrate and allow the consumer to say, hey, I am who I say I am. I want my information and I want to give permission to be able to share this with someone else. That's fundamentally how we do it. And that's actually what unlocks the ability to say, well, when we talk about this yes and approach, whether it's, the credit card data that we talked about earlier, or moving into things like, well, you know what, we need to have more visibility on the asset side, or we need to have more visibility on income side. That just becomes other data sources that you plug into that same framework. And so this framework should be durable enough and extensible enough to be able to support that yes and approach, where you say, today it's this, tomorrow we need to be here, and we want to support that infrastructure or that ecosystem. So that's what we're talking about, and what allows us to really support that yes and approach. Because otherwise, if every other account that you wanted to connect to required that additional overhead, as you said, it's brittle, it'll break. The consumer itself will never get past the fourth, credentials that they have to put in. It just won't work.
You're just going to be like, make do with what I've given you. I'm not going to give you any more, right?
That's right.
It's just, you wouldn't be willing to do it. And I do think it is interesting that it ties to like also kind of this question of like future proofing, right? Where it's like, we should expect, and this to me is maybe one of the biggest differences between the way we talk about infrastructure today versus the way we talked about it in the 70s and 80s. I think in the 70s and 80s, there was more of an expectation that like, oh, we'll do this. We'll be very prescriptive in the way that we design these systems. And our assumption is the world won't change. Or if it does change, it will change very slowly over the course of many years.
Knuckle busters will never go away.
Right. I'm sure this Metro 2 format will work forever. I mean, like there's just things like that where you're like, I don't think that's the way you think about it anymore. And so I would imagine for you guys, when you think about designing these systems, it's a question of like, look, this is what we know the gaps are today, but like a new product category is going to come in, or a new way that consumers interact with this stuff is going to be introduced. And our approach needs to be flexible enough that we can take those in without everything breaking.
Yeah, agreed. That's exactly right. And doing it in a way, as I said, that gives the control, allows the consumer to understand who they're giving permission to, does it in a secure way without the friction. Doing it that way will allow you to support whatever is now and the future, and really that sort of yes and approach that we know the market needs. And it's not going to stop. It's not like it's like, oh, well, it's yes and for the next year. It's yes and as we evolve, as more data, as additional use cases come up.
That makes sense. And I guess the other component with the consumer permissioning part, and I promised I would ask you about this, so I want to circle back to it, is FCRA, FCRA, Fair Credit Reporting Act. It's interesting because I think on one level, you could look at the FCRA as a law that was written in the 1970s that was based on a lot of understandings and assumptions that are no longer necessarily true, as we've been talking about. Didn't maybe necessarily anticipate all of the gaps that we have. But I also think another way of thinking about the FCRA is that it is both like prescriptive in terms of some of the things it's specific about, but it also sort of underlies a deeper philosophical commitment to consumers in like what your rights are as a consumer, right? In terms of like, you need to know what data, data providers have about you. You need to have the ability to make sure that it's accurate. If it's not accurate, you have to have the ability to dispute it. I've even noticed things that the credit bureaus have introduced over the years, sometimes in response to legislation and sometimes just in response to like the changing market, where it's like, hey, we want to give you the ability to freeze your credit report or to do other kind of like things. And so slowly, I think you are seeing sort of a blending together in some ways of like, how technology has changed and how the market has evolved with like the underlying philosophy, if not all of the details of kind of FCRA and those kind of things actually coming together more over time. But from your vantage point, just like why is FCRA important, and like how do you think about the compliance component of all of this?
Yeah, I think it's extremely important. I feel that, as you said, it's old. There's probably a lot of ways it should be updated and modernized, but the spirit of what it actually is trying to do, I feel we in the company feel very strongly about. It is in some ways, and this may be a bad take, but it's almost like it almost outlined a lot of rules for consumer permissioning, right?
That's how I
think
feel
about it
too.
this way,
Yeah.
right? When you think about the permissible purposes,
Yeah.
I never say the permissible purposes said like, okay, here are the purposes for which you can actually provide this data, request the data, use the data. And so if you look at that and zoom out a little bit and say, well, you know what? If we apply those now to a world where the consumer has more direct control over that permission, I think a lot of those things are still extremely important, and we model that permissioning after that. So, for example, we still have a distinction between if you're going to use the data to help educate me and be smarter or help me pay something, that's great. But if you're going to use it for actually denying me or evaluating me for credit, I should know about that, right? And so I think understanding when you permission it, how you permission it, what the consumer's rights are in that, I think the FCRA is extremely important. Mm-hmm. That's why we actually became a CRA, because we do think that there is an important distinction between when consumers, let's say, using the information just to, let's say, populate their wallet when they're buying something online. That's completely different than saying like, hey, I want to share this information for someone to evaluate me for credit. And I think it's important for the consumer to have the controls over that, and also make sure that, if someone is going to get denied for credit, things like adverse action notices and when you have to provide those, all still really, really important. So I think the FCRA does provide a really good roadmap, especially in the spirit of the law, for how you drive this consumer permissioning model. And so for us, even though, you can make an argument that, 1033 or whatever the rule ends up being, you can make an argument that it applies to all the data or it doesn't apply to the data. For us, we just took the stance and said, we should look at all of the data and understand how do we make sure that this still complies with the spirit of what these permissible purposes and what the FCRA is. And I think if you do that, you're on the right side of what needs to be done for the consumer, and you also keep your clients in the right side as well. No one wants to be all of a sudden, fined because they were not using the data correctly, right? So, as long as I think the FCRA is still incredibly important. I think it provides a ton of value for both the companies and the consumers that we serve.
Yeah, no, I agree. I mean, I've advised companies for years that just lean into the spirit of what FCRA is trying to accomplish. And sometimes it doesn't fit perfectly with some of the models or things we're talking about. I agree with you that like modernizing it would be if I could work my will on Congress, that would be something that they would tackle, because 1970 was a long time ago. But I do generally think that like it does give us a roadmap for what we think is fair, honestly, as a society, in terms of how this data is used and how we balance incentives between lenders and consumers, which, as we've been talking about, is much more difficult to do than I think people kind of assume from the outside. Tomás, this I think is a great place to leave this conversation. But before I let you go, we should just tease the fact that this is the first episode in a series that we're doing. You are going to be joining me as a co-host for the remaining 3 episodes in this series. And I think the plan that we have is, I'm really excited about it. We're essentially going to look at how changing constraints in kind of the credit data ecosystem and this yes and philosophy that we've been talking about is reshaping how credit data gets collected, how it gets used across, and this is how we're going to structure the rest of the episodes, across the lending life cycle. So we're going to have an episode coming up where we talk about acquisition. We're going to have an episode focused on kind of underwriting. We're going to have an episode where we get into servicing and just broadly talking about where the future of all of this stuff is going. I don't know if you have any words to share about your excitement for this series, but I personally can't wait to get into all those topics.
No, I'm thrilled as well. And I'm super excited about being able to take it through that life cycle and the ecosystem. And I think we're at a fantastic point in and really exciting as well in consumer credit. So really thrilled. Thanks for having me. I'm really excited to go through the series with you.
Absolutely. Well, hopefully listeners enjoyed the kickoff to this series. We'll be back with more episodes getting into the different stages of the life cycle. And Tomás, thank you so much. This was great.
Absolutely. Thanks.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.